Okay, in today's quick video, I'm going to show you how a hedge fund, mutual fund, institutional firm, etc. can buy crash protection without making an actual investment. So we all know that a lot of these large firms are constantly buying puts deep out of the money. If we look at the volume of volume and open interest, we can see thousands of contracts traded deep out of the money that large firms buy in order to hedge their portfolios. The odds are overwhelming that these contracts are going to expire worthless. And from an expense perspective, firms are spending a significant amount of capital hedging their trades for that volatility event. So 22,000 open interest for the 25s, for 28th September. And this is just one series. So like clockwork, just like you and I pay for insurance for our cars and homes, etc., institutional firms will buy deep out of the money spreads. Why? Because we've seen these 20-cent options go up to almost $20 during times of panic. And they go up by approximately 9 or 10,000%, sometimes more, and can be quite effective in hedging a portfolio. So today we're going to go over a way to buy this protection without actually laying out risk capital. So in terms of a debit. So there's still a capital requirement for the trade, but there's not a debit. You can actually offset the debit completely by selling an option. So let's go ahead and cover exactly how one would do it. There's a million ways to invert Vega in the option market. This is just one way that it can be accomplished. Okay, so here's today's market. Here's the February implosion, vol products going out of business, etc., and then a constant drift higher over the subsequent few months. We can see a swing low here at approximately 26.90. So we're going to target a short put spread below this swing low. So here we go. Let's go ahead and look at selling the 26.80 puts, and we'll buy the 26.60 puts. It's a 20-point put spread. Capital requirement for one contract is approximately $2,000. Okay, we've generated. Let's go and lock those down. We've generated $1.20 in premium, so we've generated about 6.5% in premium. And if you look at the risk profile, you can see that the odds are overwhelming, approximately 90% chance that these options will expire out of the money. Okay. On the other side of that elevated probability is a giant abyss of loss that can occur if markets sell off significantly and the trade is not managed. Okay. So the point of this video is to show you how an institutional firm can buy crash protection and not incur a debit for the transaction. And here's how you do it. So we buy those, just like they're buying all these deep out of the money, we're going to buy the deep out of the money as well, but we're going to offset it with our credit. So remember, we generated a credit of $1.30. So we're going to buy deep out of the money 1300s, and we're going to buy a 6-to-1 ratio to the put spread. So we're going to use all of this money that we generated to buy more protection. Okay, we'll lock them down at 20 cents. Okay, we're going to buy 60 of them. All right, so here we have the trade before the crash protection is added. Here's our Vega, negative $55 near the short strike. Okay, when we use all of this credit and buy as many deep out of the monies as we can, we invert Vega, and we invert Vega significantly. Okay, does very little to the P&L, the T plus 0 line, because we don't care about delta. Okay, delta is barely changing by adding these. We're not trying to offset with deltas. Our focus is to invert Vega and invert the Vega curvature. Okay, so when we engage these deep out of the money put spreads, we effectively have a gigantic hedge if volatility explodes, implied volatility explodes. Okay, so we're going to go ahead and we're going to add 55 points to the VIX. It'll take the VIX to about, or implied volatility in general, but it'll take it to approximately 68 or so. Every crash the VIX hits at least 50. In 98, I mean in 08 it hit in the 80s, and in 87 we reconstruct the VIX to approximately 180. So it's extremely possible that I could hit this number. So let's add 55 points to the VIX, and there you have it. So significant potential for profit. You could be looking at a scenario where this $2,000 investment required could generate many times the capital required to set up the trade. So $2,000 requirement could potentially generate, $140,000 or so. So this would take a significant move in the market, and it would take a move that really spikes implied volatility, but we've seen it before. This is basically a 20-cent option going to about 18 points. And we have seen that in August of a few years ago. So anyway, this is a way for an institutional firm to buy crash protection. If this trade were to expire, if all these options were to expire, the firm would have had crash protection in place. And yet, if they all expire, they will not lose money. Most firms are buying deep out of the money options for a debit, and when they expire, it's a constant drain and expense against the firm's P&L. So anyway, that's how you do it. And if you have any questions, drop us a line. Hope you found it useful, and talk to you soon.